What's the difference between marginal and effective tax rates? There's a difference. Yes, there is most definitely a difference, and it's important for you to understand the difference. So that's what we're going to talk about today. So what's up, everybody? My name is Chris Hervishon with SOAR, A Better Way CPA. Let's engage while we're going through this video. By all means, if you have any questions, ask away. If you're watching this on a recording, put your questions in the comments. Happy to go back and answer those later. So what is the difference? Well, your marginal tax rate is the rate of tax that you're going to pay on the next dollar that you earn. Okay, so when you're think about that when you're crossing over tax brackets or what tax bracket you're in, that's the most common way that people reference their marginal rate is what tax bracket are you in. Okay, now the effective rate, that's something different. That's a ratio between the amount of tax that you paid and your taxable income. Now, in my opinion, there's more than one way to look at this, and I'm going to get into that in a little bit. But it's important to understand the difference because as you move through tax brackets, basically it dilutes your marginal rate, right? So marginal rate and effective rate, those are two totally different things. Okay, marginal rate, next dollar. Effective rate is basically your blended average of what you paid on your taxable income. Okay, so this is an example tax return, came straight out of my tax software. It's demo data, so don't freak out. This is for Leeward and Starboard Catamaran. That's the names that Drake Software gave them, which is clever in itself. Okay, so over here on the left, this is everything above the line. The line is generally referred to as adjusted gross income. Okay, so as you can see here, they've got two W-2s. They're making $100,000. Nothing else going on. Just just the income from their two W-2s. Okay, full-time jobs, working for somebody else, may I add. Okay, so over here, there's no itemized deductions. Over here on the right, that is. Basically, this page is just split in two for the ease of fitting it onto a PowerPoint slide. But so over here, standard deduction, $24,000 for 2018. It gets your taxable income down to $76,000. You can see that right here. And $76,000. Tax on that, $8,742. They've got a credit for one dependent, so the child tax credit, $2,000. That gets their total tax down to $6,742. And then down here you see how much they're withheld, their calculation of the refund, yada, yada, yada. But at the very, very bottom here, you'll notice their marginal tax rate, 12%, and their effective rate, 11.5%. So your tax preparer probably gives you a sheet like this with your tax return. So this is a tax return comparison. It compares your tax situation from year to year, and then at the bottom it tells you what your marginal rate is for this year, what your effective rate is for this year. If you look at 2017 versus 2018 this year, if you've already done your tax return, you'll probably notice that there's a difference in your marginal and effective rates. So that's something to pay attention to. But this is straight out of my tax software demo data, and this is what I'm going to be showing the example based off of. Okay, so calculating the rates. This is an Excel sheet that I put together this morning. I converted this to a Google Sheet. The link to that Google Sheet is in the show notes today. It's also in the slides. The slides are going to be out on SlideShare and on Google Slides, and so you can go and check that out. Follow the link, go and play around with the Google Sheet and see how it affects your particular situation. But this exact situation is using the data from the catamarans, which I just showed you from the demo tax return, and it's out there for you to play around with using your own data. So you'll see these are the tax brackets. Okay, so over here on the left, this left-hand column, this is your these are the tax rates. See, there's the various tax brackets. There's 7 tax brackets: 10%, 12%, 22, 24, 32, 35, and 37. Right, the next column here is the lower bound of that tax bracket and the upper bound of that tax bracket. So if you'll see here in this income column, this is how the catamaran's income moves through the tax brackets. So they've got gross income up here in the yellow of $100,000. That's their W-2 income that we just talked about. And then they've got taxable income from that of $76,000. Now, the $100,000 minus the $76,000, that's your standard deduction. Okay, we just talked about that as well. So that gets you to $76,000. So the first $19,050 are going to be taxed at 10%, generating $1,900 in tax. And then the next $56,000, $57,000, call it, are going to be taxed at 12%, generating tax of $6,834. And if you'll remember, we had $8,742 on the tax return. Right down here, you'll see this calculation yields $8,739. There's just some rounding differences between the IRS tax tables, and this calculation yada, yada, yada. But for all intents and purposes, apples to apples. So that yields a marginal rate of 12%. Now, remember, the marginal rate is the tax rate on your last dollar. So their last dollar is the 76,000th dollar, which is taxed at 12%, right? So we see that right here with this 56,950. That's the remainder of what's getting taxed in that 12% bracket. Now, their effective rate, this is where it gets a little bit more interesting, is 11.5%. Now, basically what that is it's just a weighted average of how the 10% and the 12% brackets, that their income that falls into each of those brackets is getting taxed. So it's just a weighted average of the tax rate over the course of their taxable income. That yields an 11.5% calculated effective rate. And that's the effective rate that matches, and I'll go back right here to the bottom, this tax return, right here at this, the very bottom column here, all the way over on the right, 11.5%. So that ties, right? Basically what that's doing is just taking the amount of tax, $8,739, dividing it by taxable income, 11.5%. Easy enough, right? Well, and I'll go back to the tax return. The out-of-pocket tax after credits and other taxes. That's something to look for, in my opinion. This is the way that you should be thinking about it if you're thinking about your tax situation. So you'll see the credits over here of $2,000. So their total tax is actually $6,742. Now, the reason why the effective tax rate is based off of taxable income and the amount of tax calculated off of that is because credits are actually payments. They're effectively payments. So they're dollar for dollar, and then they reduce the amount of tax that you have to pay out of pocket. So if we go back here, this is why I call it out of pocket tax after credits and other taxes. Examples of other taxes are going to be like your call it Obamacare, healthcare penalty that you may be subject to if you didn't have health insurance, stuff like that. So those are like other taxes. And then credits are going to be things like the child tax credit that we just talked about, credit for other dependents, things like that. So the way that I would look at your effective rate is what are you actually paying out of pocket, okay? So in this case, the Catamarans are paying $6,742 out of pocket, and I would look at that in relation to the amount of money that you're actually bringing in. So that's actually $100,000. So they're what I'm calling the alternative effective rate. You probably won't see this on your tax return because most softwares don't look at it this way, but that's 6.7%, okay? So 6.7 versus 11.5 right down here at the bottom. Those are the two different ways, in my opinion, to look at the effective rates. Regardless, your effective rate is always going to be less than your marginal rate. And when you're comparing years to years, and this is actually an interesting year because we just had tax reform. 2018 was the first year after tax reform. So you can see the effective rate has from 2017 to 2018. That's actually an interesting analysis to do this year. That's unique because we don't get tax reform very often, right? Last time we had it was back in the 80s. It's been a bit. So if you want to see what effect the tax reform has had on you, I would, assuming that you didn't have any huge swings in income, things were relatively the same for you from year to year. The way to look at that is effective rate, and the way that I would look at that if I were a taxpayer is the alternative effective rate. So how much money are you paying out of pocket? So that's net of your credits versus what you actually brought in gross, okay? Simple enough. So last thoughts. So when you're considering how much you're being taxed or the impact of TICJA, which is the Tax Cuts and Jobs Act passed at the end of 2017, that's what I just talked about with tax reform, look at the effective rate, okay? This is interesting. Number two, if both spouses work, and the work of the second spouse, whoever that spouse may be, puts you into a different tax bracket, that's something to consider, okay? Now, here's an example. And I'll go back to the tax brackets here. I had a client this year who made basically $400,000 in gross income on his W-2. It was like $400,000 and change, right? He was right at that 32% upper bound here, right here in the middle. And his wife made pretty good income. She was around $150,000. So they were total $550,000. Now, when you look at the wife's W-2, which is at $150,000, the effective rate on that, so taking the tax withheld divided by the gross income, was around 19%. Now, if you think about it, that whole $150,000, that moves them from this upper bound of $400,000 solidly into this 35% bracket. Okay, so they're now gross $550,000. She's being withheld at 19%. In reality, every last dollar should have been withheld at 35% thinking about this at a high level, okay? And so that creates this huge disparity between what was withheld and then what was owed when the tax return was filed. There weren't any like other extenuating circumstances. It was basically just two W-2s. They both made good money. So it was a fairly easy example to provide to you. But that's something to think about. So if your spouse's income is going to put you into a different tax bracket, because those two payroll systems between your employer and her employer and his employer, they don't talk to each other, right? They just withhold based on those tax brackets and what your income is going to be in a silo. So you want to, when you're thinking about it, you want to be thinking about it holistically. Your income plus your spouse's income, where's that going to put you? Maybe that leads you to pay some estimated taxes through the course of the year. Maybe you need to change your the exemption amount on your W-4. Maybe you need extra withholding, things like that. Those are all strategies. Maybe you need to be considering some tax planning throughout the course of the year just to lower your taxable income to kind of offset that situation. So that's something to think about if you and your spouse have incomes that are going to move you between brackets, between tax brackets. Okay, and then finally, and I just talked about this, but calculating your effective rate, in my opinion, you should be using that alternative rate, which is net of tax credits, because I think I would if I were if it were me looking at this from my personal situation, I would be wanting to know what is my actual out of pocket, so your cash flow impact to you personally coming into your home. What is my cash flow impact going to be relative to the gross income that I'm bringing into my home? So because tax credits are important, right? The way that tax credits are working for 2018 and going forward, it's different now because they've essentially replaced exemptions. And so when you're calculating these effective rates, it's not necessarily going to be apples to apples from 2017 to 2018 if you're looking at it that way. Or if you're looking at it the way that a tax software would, maybe, and every tax software is going to be different. So I would look at it as an actual cash out of your pocket versus gross income, because it's going to be apples to apples, regardless of the tax law, tax changes, anything like that, and it's going to be consistent from year to year. Okay. So here are the resources for today's video. A couple articles here that are good to read. Links to those are going to be in the show notes. We're going to have a link out here to this video, which is going to be recorded on YouTube, and the slides are going to be out on SlideShare and Google Slides as well. So if you find it there, you can always link back to this video, and of course a link to my website. So that's it for me today. Let's connect. Chris@betterwaycpa.com. 843-608-0298 is the phone number. You can find me on Facebook, LinkedIn, Twitter, Quora, where I post 5 times a week, Instagram, and Pinterest. So if you're looking for me, I promise you can find me. Thanks for watching. I appreciate it, and I will see you next time.